that doesn't mean that the gold price is going to be weak, because the correlation between gold and the dollar is like negative 30%. This year, we've already seen $1 trillion of stock buybacks by corporations. Large surpluses in the silver market correspond with higher silver prices. So we're looking for a cyclical decline after 2026 within the context of a secular bull market.
Ladies and gentlemen, so today for the first time we have Jeffrey Christian, the manager partner of CPM Group. And today we will discuss what's happening with the US economy. We will discuss the commodity sector, gold, silver, portfolio structure in the current environment, and many other very interesting topics. So Jeffrey, thank you so much for being here.
Well, thank you for inviting me. I look forward to the conversation and to getting to know you better.
Thank you very much. So I would like to start by talking about the US economy. We have a lot of things going on. What's your take on what's happening and what are you paying attention to?
It's interesting because what we're seeing is a lot of economic strength. The US GDP, the second estimate for second quarter came out today, is 3.3%. The flash estimate a month ago was 3.0. We had seen a 0.5% contraction in the first quarter. You're seeing a lot of economic strength in the second quarter, but if you disaggregate it, most of what you're seeing is related to imports coming in advance of tariffs. And that shows up as a positive in the GDP, the way they recognize it. You start looking at individual sectors, and there is a lot of strength. People complain about the housing market, and definitely there's weakness in the housing market, but there's also signs of relatively healthy activity there. The prices are too high. You're having construction constraints because of immigrant labor not being available. Even legal immigrants are afraid to show up at work now. You look at the auto industry and the auto sector, it continues to suffer from both cyclical and secular problems, but the reality is that auto sales have held up relatively well. So there's strength, but if you look at leading indicators of future economic activity, that's where you see the weakness. You see weak labor markets, you see higher prices, you see constraints on capital markets, and there are a lot of signs that the economy could deteriorate sharply over the next 6 to 9 months. Yeah. And people talk about, well, how do we get into a recession and what are the leading indicators of a recession? And the reality is that it's hard to say how we get into a recession because we get into recessions in different ways. Sometimes we slide into them. Other times, and perhaps more typically, we plunge into them from periods of strong economic growth, which puts upward pressure on the need for capital and interest rates and inflationary pressures. And that seems to be where we are right now. But that said, as Chairman Powell said last Friday out in Wyoming, we're in a place where we haven't been economically since the 1920s and 1930s, and we don't have clear guides as to what the implications will be of the tariffs on economic activity, on immigration policies. The United States is a country, like many other countries in Europe and Japan and South Korea, that are heavily dependent on immigrant labor. And we are seeing problems in the agricultural sector, in the food processing sector, in housing and construction, and in a number of other areas as well. There's a tremendous amount of uncertainty. And one of the points that we've been making, really, I guess, for the last 6 or 9 months is the risks and uncertainty are greater now than at any time since December 1941. So we really are in uncharted territory. And you can look and say, well, this is what happened in the 20s and this is what happened in the 30s. But the reality is that the economics and the economic structure, not only of the United States, but on the wide basis, is radically different from what it was back then. So that may not be a good era to look back at for historical precedents. We're in uncharted territories.
Yes, and Fed is in a very difficult position as well. And Trump's trying to put pressure, Trump's trying to remove Powell. What's your take, Jeff, on what's happening with all this mess with the Fed and Trump and everything?
Well, it's funny because, yes, Trump is really playing with fire with the Fed. And first, let's talk about that. And you're seeing that now. Interest rates have come off a little bit in today and yesterday, but you're seeing that in that the Fed's independence and central bank independence. Central bank independence is under fire globally, and in the United States, it's bad. And because the Treasury has such a high credit rating and is sort of like the least risky place to borrow, to lend money right now, the Fed and the Treasury have a tough place to be in. And Trump trying to bully it into doing things that it ought not to do is very detrimental for the dollar, and it's very detrimental for U.S. interest rates and Treasury interest rates and Treasury borrowing power. So that's a real problem. But I want to say something else. Trump's trying to bully the Fed into doing things, as problematic as that is part of a much larger problem, which is he's trying to bully everybody around the world. He doesn't negotiate. He doesn't do deals. He extorts and he bullies, and he's causing a tremendous amount of difficulty across economic and social and political sectors. The Fed is a problem. It's a problem that's very central to my business and my life, but it's also part of a much broader authoritarian threat to the post-World War II global economic order.
Yes, and if we look at the recent situation with Intel and Trump really saying that he wants the government to get involved more and more with private companies, where could that bring us, Jeff?
Well, that's the definition of fascism. I hate to use the term because it's so loaded, but if you look at the rise of fascism in Italy, it came about after World War I, at a time when communism and socialism were rising in Italy politically, and people got together and said, corporations got together and said the government should be working for corporations. Yeah, not people, corporations. And the definition of fascism is state corporatism. And that's where there are elements in the government, and they're in power right now. They are pushing in that direction. And it's very problematic because if you look at history, fascism hasn't done as well for people and overall economics as have liberal capitalism.
And so you mentioned the US dollar as well, Jeff. If we look at the US dollar compared to other currencies, it has been relatively weak recently. But if you look at the big picture with, I suppose, deglobalization happening in a way, and all these trends with central banks getting involved with gold, what do you see happening with the dollar in the short term and the long term as well?
It's interesting because, people talk about how the dollar is off about 7%, 8% from where it was at the beginning of the year, but it's up like 10, 12% from where it was in 2021 at the end of the COVID period. And it's up something like 40 or 50% from where it was in 2012, the end of the global financial crisis and Great Recession. So the dollar's actually been very strong. And our expectation is that it will continue to be relatively strong. And if you talk to mainstream economists and people who work at the World Bank and the IMF and the OECD, they see that. There are gold proponents and gold marketers who keep talking about how the dollar is collapsing and no one's buying treasuries. None of that is actually accurate. I mean, holdings of U.S. Treasuries by offshore investors are at record levels, and they've been rising at 10% per annum over the last 2-3 years. Yeah, people are actually flocking to the U.S. Treasury and the dollar because the Treasury is less risky than other governments' sovereign debt and corporate debt and private debt. And the world has exploded in corporate and total debt. It's over $300 trillion. It's more than 120% of global GDP. And if you look at that $300 trillion, 36 trillion of it or 37 trillion of it is the US government. And that's like the least risky or among the least risky places where you can loan money right now. That suggests to us that the dollar will continue to be relatively strong. Obviously, some other countries are doing better, and there's a impulse that's going on for 40 years to diversify away from the dollar, but strength begets strength, and the dollar has actually gained position in terms of its role as a monetary reserve asset and as an asset for private holdings on a global basis. So I see the dollar staying relatively strong. Now I'll say, because I'm a gold analyst, that doesn't mean that the gold price is going to be weak, because the correlation between gold and the dollar is like negative 30%. 2/3 of the time, a stronger dollar does not mean a weaker gold price. And gold is actually, it's like the dollar. It's the other safe haven asset. Gold, silver, and the dollar are where people go when economic and political times are tough. So you're seeing strength in the dollar, you're seeing strength in gold, and you're seeing strength in silver. And that ought not to be a surprise to anyone.
And just a little bit more on the dollar, Jeff. If we look at Trump's recent actions and the way he's trying to use the US strength to get other countries to do what he wants them to do.
Mm-hmm.
And also if we talk about the fact that, the Russian assets were frozen, and I'm not saying if that's good or bad, just from the dollar perspective, would that not be bearish for the dollar over the long term?
In the long term, that's true. But look, I've been in this business now. This is my 50th year of writing about commodities and studying commodities. And so I started in 1975, 4 years after we went to floating exchange rates. And people were talking about how the world would move away from the dollar. And at that time, probably, I'm not sure what the number is, but it was less than 50% of monetary reserves were US dollars. And today it's around 60%, 58, 60%. So, and I've worked with central banks since 1980, 1981. And central banks have always said, we'd like to diversify away from the dollar. But the fact of the matter is, a Polish central banker told me in 1981, I was working at a company that had gold loans out with the Polish central bank. They had lent us gold. We had done a gold swap. They needed foreign exchange. They needed US dollars and Deutschmark. So we lent them money and we took gold as collateral. And so we were a creditor when the Polish central bank ran into financial problems in 1981. And we were working on a workout of this insolvent loan. And one of the central bankers from the Central Bank of Poland said to me, Mr. Christian, you don't understand. If you owe a bank enough, you own it. And that's where the United States is. Because of the dominance of the US dollar, that dominance begets dominance. So it's very difficult for people. If you look at a lot of central banks, they have net inflows because they're net exporters. They have net inflows of US dollars every month. And they want to reduce their dollar holdings. So a lot of times they're buying other currencies with a portion of their net inflow of dollars. And at the end of the month, they've actually added to their dollar holdings because the liquidity in those other currencies is insufficient to absorb all of the dollars that you would sell in order to diversify your dollar holdings. And it's not just central banks that are in that position. There are corporations and others, pension funds.
Okay, yes, that's a good point, Jeff. And just before we move to the commodities and the precious metals, I would like to just mention the stock market. With the current valuation, Jeff, and with the way people are sort of trained to buy the lows and everyone wants to get involved, what are your view on the current valuations of the S&P 500?
Well, I think the stock market's overvalued. And if you look at it, you have a few large companies that have these incredibly inflated and unrealistic valuations that have distorted the stock market's valuation. So on the one hand, I look at the stock market and I say this is overvalued. Another hand, on a longer term basis, I look at it from a fundamental perspective, and I see that the relationship between the stock market and stock prices, the equity markets, and capital formation for corporations is broken, or is breaking. And it's been breaking for 25 years now, and it's gotten worse. So you have a real problem in that the equity market is no longer the place where corporations can go for capital formation as easily as they used to, unless they're one of those largest companies. So again, it's like dominance begets dominance. People say, I don't want to invest in these smaller companies that need money. I want to invest in the big guy because other investors are buying into it and they're driving it up. Now, I saw a figure that this year, we've already seen $1 trillion of stock buybacks by corporations in the US stock market. That's goosing the price higher. I can make my stock rise by taking my profits, and instead of hiring people, instead of building new factories, instead of buying equipment, manufacturing equipment, I'm going to buy my stock back with my profits, and that's going to goose my stock price higher. So the stock market has become even more of a casino and less relevant to the real economic environment than ever before. So I do see it as being overvalued, but I don't necessarily see that as being relevant to where the stock prices are going to go, because the stock prices no longer reflect the health of the economy and the health of those corporations.
Yeah, yes, really good points here, Jeff. And let's move to gold. Gold has performed quite well recently. And, the miners, the companies are doing really good, at least all the good ones, with very good free cash flows. But before we get to that, Jeff, what's your take on the current gold prices and where do you believe it could be heading in the next 6 to 12 months?
Right. I mean, gold prices have been rising, and really they've been rising since 2019, the second half of 2019. And they've been rising because investors worldwide are buying more gold. And they're buying more gold because of those economic and political and social anxieties and uncertainties and risks that have just grown exponentially over the last 6 years. And we don't see that economic and political environment changing anytime soon. So we expect investors will continue to buy historically large amounts of gold, and that will continue to drive the gold price higher. So we're looking for even higher gold prices over the next 6 quarters at least, into 2027.
But Jeff, when I look at everything that's happening around me, I don't really hear anyone talking about gold and precious metals. And then I actually don't think I've ever met a real person in real life talking about the miners. So would that not mean that we have, a lot further to go, and that the masses, especially in the West, are still not interested at all?
I think people are, but I also think that they don't. Intelligent people don't necessarily want to talk about gold. Yeah. I worked at J. Aron, 1980, 1981. In late 1981, we were bought by Goldman Sachs. And Goldman bought us because they realized that a lot of their clients were buying gold and silver, and they didn't have the mechanism, they didn't have a metals trading desk. And so they had a standing offer to buy J. Aron, and J. Aron finally said, okay, fine. So Goldman bought us at the top of the market. Yeah. And we had this recurring event where we would go see Goldman clients, and some of these were very, very wealthy families, and some of them were corporations or private banks. And the salesperson would say, you know, I'm very good friends with this person. You know, we take vacations together. He's not really interested in gold, but I thought I wanted to introduce you to him because it's a good topic to talk about. And we would go in there, and the guy would say, yeah, you know, our bank, our fund, we have been buying gold from J. Aron for 5 years. And the salesman would say, well, you never told me that. And he would say, well, Goldman's position until you bought Aron was that gold was for crazy people. And I didn't want my best friend thinking that I'm insane. So I didn't tell you. Yeah, so that's a cute little anecdote. But the reality is gold and silver are the places with the greatest secrecy among major financial assets. And if you want to have secrecy surrounding your wealth, A, you buy gold and silver, and B, you don't talk about it. You know, it's like people who talk about gold don't necessarily have the kind of position in gold that you think. I mean, and we've had family offices and small funds and such, and they've come to us and they said we want to start buying gold, and we start working with them, and it turns out that their ancestors had bought gold, and they already had gold in their portfolio. Yeah, but they hadn't told them.
Hmm. And Jeff, would you be interested in miners at the current levels? I mean, if the commodity price look bullish and the good companies are already printing cash at the current levels, things look really good for miners.
I am interested in miners. I'm very selective about them. There are management issues, and there are a host of other risks that relate to mining that don't relate to bullion. But I'm a commodities analyst registered with the CFTC and the NFA. And so I speak in public about precious metals and commodities. I'm not SEC registered, so I'm not supposed to be, you know, giving recommendations about which mining companies I like. But yeah, I like mining companies. I advise my clients who are qualified eligible participants or exempt investor groups. I always recommend to them that they have a diversified precious metals portfolio that includes gold and silver, physical metal, and mining companies, and possibly various derivatives too.
And without going into the details, Jeff, would there be a certain stage on the Lassonde curve where you could be more interested in?
I'm sorry, what?
Would there be a stage on the Lassonde curve? So would it be the big producers, the developers, the juniors that you could be more interested in at this stage of the bull market?
I am most interested in those exploration and pre-development companies where I feel very confident about the management, and also mid-tier companies that are takeover targets of majors that are looking to boost their reserves and resources.
Yes, that makes sense. And would you be interested in royalty companies as well, Jeff?
Royalty companies are very interesting because, like a scrap refiner, they don't have all of the capital overhead that the miners have.
Hmm. So I would like to move on to silver. Would your expectations and bullishness or bearishness on silver be similar to gold?
They're a little bit different. I was just looking at what the silver price was. So, or is. Silver is not quite as universally pursued as gold uh, by investors. So you've seen silver prices lag gold over the last few years. And that partly reflects the fact that people are more interested in gold than they are in silver. And it also partly reflects the fact that the there were a lot of investors who bought silver 2011, 2012, but more importantly, 2021, when there were a bunch of these scams going around about squeezing silver and bankrupting JP Morgan by driving the silver price up and draining COMEX inventories. It was all nonsense. It was all, and a lot of the people who were financing that talk knew that it was nonsense, but they're selling precious metals to retail investors. And they got the price spiked up to about $30 an ounce. And these retail investors were buying small coins and medallions and small bars. They were paying exorbitant premiums. So they were paying $30, $35, $40 an ounce. And then that all collapsed. And what we've seen over the last 2 years is a lot of investors who had overbought. They fell victim to these scams, the Wall Street silver squeeze scams, and they lost a lot of money because the price went from $40 for their products to something like $16 or $15. So now that the price has risen again, once it got over $28 an ounce, you started seeing investors selling a lot of that silver. And you've probably heard the anecdotes. I mean, there are coin dealers and bullion dealers around the world, but especially in North America, who ran out of cash because people were selling them so much of this silver back to them to take advantage of the fact that the price was over 30, then it was over 35, and now it's 39, trying to get to 40. There was so much of that silver being sold by disenchanted investors who had drunk the Kool-Aid and their wives said, get that garbage out of the basement. And they could finally, recoup their investment. That put a cap on silver over the last couple of years. To some extent, a lot of that silver now has been sold. And to some extent, you're seeing the same thing you saw in 1979 and in 2004. And those were the periods of the previous two spikes in higher silver prices. And what really triggered it was not so much fresh investor buying initially, but those investors who were stale bull liquidators, who were selling their silver because they were disenchanted, stopped and said, you know what? I think the silver market's changing, shifting gears. It's moving from deficits to points where investors are starting to buy. And maybe if I wait until tomorrow to sell my silver, I'll get a higher price than I got today. And what you saw in that period, say 1978, 1979, and then again in that period 2000, really 2000 to 2005, was the first thing you saw was a reduction of stale bull liquidation by existing silver investors, which tightened the market and started to move the price up. And then once the price started moving up, they said, okay, yeah, I'm waiting. And other investors said, hey, the price of silver is rising again. It touched $50 once before or twice before. Maybe I should buy silver. Yeah. And if going back to like the period 2004 to 2007, we picked up a lot of very wealthy investors at that point who had made their money in real estate. And by 2004, the economics of being a real estate investor started to be, the risk reward profile started to shift more to the risk side than to the reward side. And by 2005, 2006, it was screaming, get out of real estate. And a lot of people sold their real estate investments and bought silver and gold. So we had a lot of clients that came to us in 2004, 2006, saying, hey, I made all this money in real estate. I'm interested in gold and silver. Help me invest wisely. And, unfortunately for us, in late 2011, early 2012, we told them, okay, this is the peak, sell. And so they sold their gold and silver and they stopped being our clients for a few years.
And so, Jeff, if we look historically, though, it's sort of normal for silver to behave this way. If you look at all other bull markets, usually gold performs first and then silver begins to perform really well near the end of the bull market, and then it has this huge spike. So would you expect something similar to happen this time around?
We are expecting it. I'm not quite sure. That's something that's like a pater noster that you hear in the silver market. Don't worry about the fact that silver's lagging gold. It always lags gold. I'm not sure that's actually accurate, but that's what the market believes. And what the market believes is often more important to the price than what actually has happened historically. And so I think that you can see that. And part of that, it reflects the fact that, the silver market, in terms of the dollar value of investment demand, is probably about 10% of the gold market. So it doesn't take nearly as much money to move the silver price up as it does gold. And you get the situation where you have now where gold prices are very high. So people start saying, well, okay, gold price may be too high, so let me invest in silver instead.
And do you have any insights into the supply and demand fundamentals right now with silver?
Sure. I mean, CPM Group has been producing the best fundamental data on supply and demand for gold, silver, platinum, blue since the 70s. And our data is clearly superior to the stuff that marketers put out. And I say that it's clearly because if you look at our track record of calling the markets is based on our fundamentals, and we have a really good track record in calling these markets up and down. So yeah, we do have it. So you're seeing in the gold market, you're seeing gold investment demand rise very sharply last year and again this year. And that's what's been propelling the price. Central banks have actually pulled back a little bit because of the higher price. They tend to be more price sensitive. When investors are buying gold and bidding the price up, central banks will pull back. And then when investors buy less gold and the price comes off, the central banks will step up and buy more. But you are seeing some central bank buying. It's not as strong as some people. It's probably around 10 million ounces, up from maybe 8 million ounces last year. And fabrication demand obviously is suffering from the higher price. Mine production is doing well. Secondary recovery is doing well because of the higher price. And you see that gold coming into the market much more rapidly because, if you're building a mine, it's going to take years. But if you're a scrap recycler, it takes 2 weeks to have refined metal to sell. So, that's a story. In silver, there's this concept that the silver market's in a deficit, but that's a marketing hype. And that's predicated on the adding dummy variables for investment demand to fabrication demand. If you look at total supply of silver, which has been flat for maybe 10, 15 years, up a little bit. If you look at total supply less fabrication demand, you have a large surplus. And large surpluses in the silver market correspond with higher silver prices. If you plot our data for supply and demand, surpluses and deficits relative to the price of silver, if you plot those two variables, what you find is when you're in a deficit, as you were from 1990 to 2005, the price of silver is low and flat. And during that period of time, you saw massive deficits because the price was low. Fabricators were using more silver, miners and scrap dealers were producing less, and you had these deficits. And investors were sellers, and the price flatlined between $3.50 and $5.50 for 15 years. Toward the end of that period, investors stopped selling as much, and the price started rising. And then that started to bring the investors back in. Surpluses, the way you do the math properly, total supply less fabrication demand equals deficits or surpluses. Surpluses represent periods of time when investors are net buyers and net buyers of a lot of silver. So you saw a surplus in 1979, 1980 into 1989, and the price was very strong. The price fell in the late 80s and the early 90s as investors kind of lost interest in silver. And then you've seen very big surpluses since 2005. And those surpluses represent investors buying increased amounts of silver and bidding the silver price away from fabricators, right? So they say, investors say, A, we have a lot more money than fabricators. B, we have total discretion. And C, we're worried about the state of the world, so we're going to be buying silver. They buy silver and they're willing to pay higher prices. Fabricators say the price of silver is rising. We have to look how we can economize our silver use or even substitute away from silver. And then mining companies say, okay, can mine more silver now because the price is higher. And scrap tends to rise because the higher price brings in people saying, here's my grandmother's silverware, here's my mother's jewelry, let me sell it for the metal content. So you tend to see surpluses correspond with higher prices. You're seeing large surpluses since 2005. They got a little bit low in 2017, 2018, 2019, but then they started rising again. And over the last couple of years, as with gold, you've seen a very strong increase in investment demand, which is pushing the price of silver up.
Okay, and how, Jeff, would you expect this situation to resolve for the next few years?
That's the problem. And, one of the main criticisms, which I don't necessarily have a response to, we have gold and silver prices rising on investment demand through 2026 into 2027. And then we have it coming off some. And people say, well, does that imply that all of these economic and political issues will be solved by 2027? And our answer is no, it doesn't. I'm not quite sure what it implies. But, we don't see if you look at cause and effect, prices rise when investors buy gold and silver. Investors buy gold and silver when the economic and political world scares them. And the economic and political world has been scaring investors really since 2000, and it's just gotten worse and worse and worse. There are periods 2014 to 2017 when investors back off a little bit. And that's what we're looking for beyond 2027. We're not looking for somebody saying, oh, all of those economic and political problems have been solved. I don't need gold and silver anymore. We don't see that happening. We see investors saying, okay, gold's now, I'll give you a hint, gold's close to $4,000 or gold's trading around $4,000 an ounce. Silver's trading around $45 to $50 an ounce. And we're getting accustomed to the economic and political problems. So I'm a little bit less concerned about the state of the world. I learned how to live with it over the last 3 years, and I can buy less gold and silver. So we're looking for a cyclical decline after 2026 within the context of a secular bull market for gold and silver.
Okay, that's a very interesting point. Thanks for that, Jeff. And if we talk about the whole commodity sector, would there be any other commodities you would be interested in right now? Would it be copper, maybe uranium, or anything else?
Well, as an analyst, I'm interested in a lot of markets right now. But for an investor, I would say copper. Platinum and palladium offer agile investors opportunities to come in long and then get out. We saw this in June and July. The price of platinum was flatlining between $800 and $1,100 from 2014 to 2025. And in June, there was an uptick in investment demand, which took the price over 1,100. It promptly went within the matter of 6 weeks to 1,500. So it added 50% to the value. And it's caught up half of that now. The price is $1,350 today. So it's given up 150 of the $400 that it had made once it broke above 1,100. That's the kind of opportunities I see in platinum and in palladium. Copper, I'm more of a long-term bull and a short-term cautious bear. I don't see the copper price falling sharply because of the state of the world. But I also think that there's way too much bullishness about copper as a strategic metal and copper being in short supply and such. So from an investment perspective, I'm primarily interested in gold and silver. I see platinum and palladium as something that agile investors can get in and get out, and that these kinds of spikes will occur more and more over the next several years as platinum and palladium mine production declines, perhaps more rapidly than automotive use of platinum, palladium, and rhodium in catalysts. And then copper I like from a longer term perspective because of the fundamentals. But that's as an investor. As an analyst, there are all kinds of specialty metals that I'm fascinated in, primarily because many of them are not primarily mined. They're byproducts of other metals, and they have increased use in high-tech applications that require increased demand that is not necessarily easily met with new supply or scrap. I wouldn't advise investors to invest in those because they're extremely illiquid markets. There's no terminal market. There are very few participants. And I've seen a lot of investors buy cobalt or rhodium. And then when it comes time to sell, they get half the price because you have to sell back to the guy that you bought it from, and he knows your situation. You're not calling to buy more. You're calling to sell. So the bid-ask spread, I've seen bid-ask spreads for non-traded metals of 100%, where, I'll sell it to you at twice as much as I'll buy it from you.
That makes a lot of sense. So Jeff, I like to ask this question for the younger audience. If we have an individual who's still at the beginning of his and her wealth-building path, and they have so many choices with the crypto sector, the NVIDIAs, the things that we're discussing right now, what advice would you have for that individual on how they could start their wealth-building path and not get burned too much?
It's interesting because, there's been a lot of work done on portfolio and wealth creation. And there's this $20,000 threshold, at least in the United States. I don't know if you've heard about this, but, the way that individual, first off, never think about, oh, I want to put 50% or 100% of my savings in gold and silver. These are commodities. Historically, if you've had 20 to 30% of your savings, long-term savings in gold and silver, you've done really optimally. But these are things that should be a portion of your portfolio, but not your entire portfolio. I don't like cryptos. I tell people, you say, where do you see the kind of volatility in cryptos that you see in cryptos? And the volatility that you see in cryptos is equivalent or similar to what you see in a slot machine. So I don't like cryptos and I avoid them. I like distributed ledger protocols, but that's beside the point. But my advice to younger people is, you start buying small amounts of gold or silver. When you have, a certain amount of money in your savings, start moving some money into gold and silver as a long-term insurance policy and portfolio diversifier and a hedge. Hedge not only your numerator, whether it's stocks or bonds, but also hedge your denominator away from the dollar, right? So you have something that is, it's still denominated in dollars for sales, but you have it also as a numerator and a denominator. So don't race into gold and silver. Don't follow the lead. I mean, I mentioned central banks and gold. Investors will buy into a rally and they'll drive the price up. And that's what you're seeing in gold and silver and a lot of other things, including the cryptos. Central banks and well-run funds and investors will buy low and sell high. So you don't necessarily race into a bull market. And looking at the markets for gold and silver today, you could say, okay, I'm going to be saving my money. And when the gold price comes down, that's when I'll buy some. If you look at like the People's Bank of China, People's Bank of China was buying gold on a monthly basis until the middle of 2019. They stopped buying when the gold price started rising in July of 2019. They did not buy gold from July of 2019 until November of 2022. The gold price, meanwhile, went from $1,080 or something to 2,000 something. In early 2022, the gold price was $2,064. The Central Bank of China was not buying. Other people had been buying and they had driven it up that high. Economics started to deteriorate. People started worrying that we were going into a recession, increased tensions among countries. Russia invaded Ukraine. China was saber rattling with Taiwan about Taiwan. People started selling their gold. The price went from $2,060 in the first quarter of 2022 to $1,680 in the fourth quarter. When it got to 1680, the People's Bank of China said, okay, it's still high, but it's off 20% from where it was 8 months ago. I'm a buyer. Yeah. So you don't necessarily have to say, I'm going to wait until the price gets down to 1680. But if you see a cyclical decline in gold and silver, and you buy CPM Group's research concept that it's a cyclical decline in a secular bull market, that's when you buy.
That's a very good point, Jeff. Thanks for that. So these are all the questions I had, sir. Is there anything else you would like to mention? Is there anything else that maybe we haven't spoken to that you're paying attention to?
Well, I'll just, Bernard Baruch, who was a great investor and a fascinating fellow and a great philanthropist in a way. People asked him, how did he make his money? He said, I buy straw hats in the autumn and I sell them in the spring. When everybody's buying straw hats, that's when you want to be a seller. And when everybody's selling straw hats or not buying them and the price falls, that's when you want to buy them and build inventory. So that's it. The other thing I would say is, precious metals have always been a place where the scoundrels of finance go. And a Canadian fellow who's passed away explained it once. He said, if you've been barred from the equity market and the bond market and the commodities futures market by regulators because you do bad things, you can still be involved in the physical gold and silver markets because they don't have those kinds of regulatory oversights. And, I've been in this business for 50 years and the market has always been plagued by charlatans and such. I sometimes make the crude joke that gold is sort of like sex. There are a lot of people who think they're experts about it, but they really don't know anything about it. But crude jokes aside, and I'll probably get, slammed for being unwoken for saying that. It's true. You have to be extremely cautious about where you get your information and whether you believe it. And there are a lot of guys, I'm sure you run into them all the time. And you say, well, you're talking about the collapse of the dollar or remonetization of gold, but you've been talking about that your entire career and it hasn't happened. Maybe your analysis of the world is wrong. So you got to do the work. If you don't do the homework, you should expect to flunk the course.
But Jeff, I really enjoyed our conversation. Thank you very much for being here, and I hope to have you back, sir.
Thanks for having me. Welcome to come back anytime you want. And if your viewers want, they can go to cpmgroup.com and learn more about us.